Topic explains yield and yield spread measures for fixed-rate bonds, focusing on how investors evaluate expected returns and compare fixed-income securities across markets. Yield measures summarize the return an investor can expect from a bond based on its price, coupon payments, and maturity. Because bonds may differ in coupon frequency, embedded options, and market pricing, analysts use several yield calculations to assess investment attractiveness accurately. Yield spread measures further compare a bond's yield with a benchmark security or curve, helping investors evaluate compensation for credit risk, liquidity risk, taxation, and other factors influencing bond pricing within global fixed-income markets. Yield to maturity, or YTM, is the most widely used bond yield measure. YTM represents the internal rate of return earned if an investor purchases a bond at its current market price and holds it until maturity while receiving all promised coupon and principal payments. The calculation assumes coupon payments are reinvested at the same yield and that the issuer does not default. When a bond trades at par value, the coupon rate equals the YTM. Bonds trading at discounts have yields above the coupon rate, while premium bonds have yields below the coupon rate. YTM therefore incorporates both coupon income and capital gains or losses over the investment horizon. The topic also emphasizes the impact of compounding frequency on annualized bond yields. Bonds may make coupon payments annually, semi-annually, quarterly, or monthly, and different payment frequencies affect the effective annual return received by investors. For example, semi-annual compounding results in a higher effective annual yield than annual compounding at the same stated rate because interest is earned more frequently. Market convention often quotes YTM on a bond equivalent basis using semi-annual compounding. Analysts must therefore distinguish between stated yields and effective annual yields when comparing securities with different compounding structures. Accurate interpretation of yield periodicity is essential for evaluating investment returns and making valid comparisons across fixed income instruments. Several alternative yield measures are used in fixed income analysis. Current yield equals a bond's annual coupon payment divided by its current market price and provides a simple measure of income return. However, current yield ignores capital gains or losses arising from the difference between market price and maturity value. Simple yield adjusts current yield by incorporating straight-line amortization of discounts or premiums. For callable bonds, analysts may calculate yield to call based on the first or subsequent call dates rather than maturity. The lowest yield among all possible call dates and maturity scenarios is known as yield to worst, an important risk measure for investors evaluating callable securities. Yield spreads measure the difference between a bond's yield and the yield of a benchmark security or benchmark yield curve. These spreads help investors assess compensation for additional risks beyond those of benchmark securities. Government spreads, or G-spreads, compare corporate bond yields with government bond yields of similar maturity. Interpolated spreads, or I-spreads, use swap curves as benchmarks rather than government securities. Yield spreads widen when investors perceive greater risk or reduced liquidity and narrow when market conditions improve. Consequently, spread analysis is widely used in credit evaluation, portfolio management, and relative value trading strategies within fixed income markets. The zero volatility spread, commonly called the Z-spread, provides a more precise measure of credit and liquidity compensation by adding a constant spread to each spot rate along a benchmark yield curve. The spread is adjusted until the present value of the bond's cash flows equals its current market price. Unlike simpler spread measures, the Z-spread accounts for the timing of all individual cash flows rather than relying on a single benchmark maturity. Analysts use Z-spreads extensively when evaluating corporate bonds and structured securities because they provide a more comprehensive assessment of compensation for risks embedded within the bond's pricing structure and expected cash flow pattern. For bonds with embedded options, analysts frequently use option-adjusted spread, or OAS, to isolate compensation for non-option-related risks. Callable bonds, for example, contain embedded call options benefiting issuers by allowing early redemption when interest rates decline. The value of this option affects bond pricing and yield spreads. OAS removes the value of the embedded option from the Z-spread, leaving a spread that reflects compensation for credit, liquidity, and taxation risks alone. Callable bonds generally have higher Z-spreads than OAS values because part of the spread compensates investors for call risk. OAS analysis is therefore essential when comparing bonds with differing embedded option features. Topic ultimately demonstrates the importance of yield analysis in fixed income investing and risk assessment. Different yield measures provide distinct perspectives on expected returns, while spread measures help investors evaluate compensation for credit risk, liquidity risk, and embedded options. Accurate interpretation of yields requires understanding compounding conventions, pricing relationships, and the impact of bond features such as call provisions. Yield spread analysis also provides valuable insights into market sentiment, economic expectations, and relative value opportunities across sectors and issuers. Mastery of these concepts enables analysts and portfolio managers to evaluate fixed income securities effectively and make informed investment decisions in complex global bond markets.